You know, in Japan's booming creator economy, there's this one company, Note Inc., that's making an absolutely massive bet on AI. And yeah, they're posting some incredible growth numbers, but when you actually dig into their financials, well, the story gets a whole lot more complicated. So in this breakdown, we're going to pop the hood and really analyze their 2025 investment case.
All right, let's kick things off with the big headline number, a 25% annual revenue growth for fiscal year 2025. I mean, wow, that's not just steady progress, right? That's some serious momentum. But the real question, the one we're here to answer, is what's actually driving it? And more importantly, can they keep it up?
So what's fueling this fire? Well, the answer, and this is really the main theme of our whole analysis, is AI. But here's the kicker. Note isn't just using AI. They're making a huge strategic pivot to become a core part of the AI industry itself. Let's break down how they're doing it.
And here you can see that 25% growth in action. Just look at that jump from about $22 million to almost $28 million in a single year. And believe me, this kind of growth isn't an accident. It's the direct result of that big AI pivot we were just talking about.
Okay, this slide really gets to the heart of their AI strategy, and it's a critical distinction to make. It's not about them just using some AI tools. No, it's about becoming an AI supplier. They've got this thing called the GENIAC project, where they're basically turning their gigantic library of over 69 million pieces of creator content into valuable training data for AI models. And to pull this off, they've landed some huge partnerships. Google's bringing the advanced AI tech, and NAVER is handling the global distribution side of things.
All right, so you're probably wondering, how does this whole AI strategy actually make them money? Well, the company's business model is pretty smart. It's built on these two separate engines, which gives them both scale and a good bit of stability.
So if you look at the breakdown here, the vast majority, we're talking almost 80%, comes from their main creator-to-consumer platform. That's where you and I would go to buy content. But check out that growing B2B slice. That's their software-as-a-service business. That 16% might not look like a lot, but it represents stable, recurring revenue from companies, which is a super important balance to the more up-and-down consumer side. And get this, both of those engines are absolutely firing on all cylinders. The gross merchandise volume, that's just the total value of all the stuff sold on the consumer platform, it's up almost 25%. But, and this is the really exciting part, the B2B business is growing even faster. Its annual recurring revenue, or ARR, shot up by over 34%. That tells you their corporate product is really starting to catch on. Okay, so this diagram here is straight from their own investor deck, and it really lays out their grand vision. Now, I know it's in Japanese, but the key thing to see is how they put Note right smack in the middle of this new ecosystem. They see themselves as the central hub, right? They're connecting creators in their content, which notice how they frame it as high-quality data to a global audience. And what's connecting everything? AI, and their big partners like Google. It's a really ambitious plan for sure.
But hey, a good analysis never just stops at the surface, right? Now it's time to pop the hood and really dig into the financials. And let me tell you, this is where the story gets a little more complex and frankly, a whole lot more interesting.
Okay, look at this number, 93.6%. On paper, that is an absolute dream for any investor. A reported gross margin that high suggests this is a ridiculously efficient, high-margin business. But, and you knew there was a but coming, this is where we really need to look closer.
So the crucial insight here is all in the accounting. See, Note reports its cost of goods sold, or COGS, as being mostly R&D staff costs. But the actual direct costs of running the platform, things like over $6.5 million in payment processing fees and over $4 million in cloud hosting, well, they classify those under SG&A. For a platform business, though, those are fundamental operational costs. They're not just overhead.
So what happens when we do the math ourselves and reclassify those platform costs where they arguably belong? Bam! The gross margin gets cut dramatically. That dream number of nearly 94% suddenly becomes a much more realistic 54.7%. Now look, that's still a really healthy margin, but it paints a fundamentally different picture of the company's real core profitability. Okay, so now that we've seen the good and the complicated, let's talk about the challenges. Because no growth story is perfect, right? We're going to look at the 3 core risks that analysts have flagged, and these are things every potential investor absolutely needs to understand.
First up is what we call profit quality.
Get this, an incredible 41% of their 2025 net profit didn't actually come from running the business. It came from a one-time deferred tax asset adjustment, basically an accounting trick. So what does that mean? It means the underlying business was way less profitable that year than the big headline number would have you believe.
Second risk, category over-reliance. A really big chunk of their revenue comes from these very specific, let's call them money-motivated niches. Think horse racing tips, stock market advice, that kind of thing. And that makes the platform super vulnerable. I mean, what if regulators decide to crack down on these areas? Or what if a big scandal hits and erodes trust? It could seriously hurt their revenue, and fast.
And finally, number 3, aggressive incentives. The executive stock options are all tied to this incredibly ambitious revenue target for 2030. We're talking nearly $67 million. Now, on one hand, that's great for driving performance, but on the other, it could push them to make risky, short-term moves just to hit that number. Like sacrificing profits for revenue, which could really damage the company's stability in the long run.
Okay, so let's bring this all together. We've got the incredible AI-powered growth story on one side, the bull case, and on the other, we've dug up some tricky financial details and some pretty serious strategic risks, the bear case. So, what's the final verdict here?
This quote from the research brief really hits the nail on the head. It reframes how you should think about the whole company. It says, Note Inc. is not a media company, but a creator financial leverage platform. The key idea here is that they're not just a place for content. They are actively using that content and the money it generates to build up their own financial power. That is a really, really critical distinction to make.
And that right there leads us to the absolute core of the investment thesis. If you put your money in Note today, you are making a bet on one single crucial transformation. Can they pull it off? Can they actually evolve from being just a platform for creators into an essential data supplier for the entire AI industry?
And this is the price of that bet, a price-to-earnings ratio of almost 62. Let's be clear, that is a premium valuation. What it tells us is that the market already believes the growth story. All of that future success we're talking about, it's already baked right into the stock price today.
And so that brings us to the final and most important question you have to ask yourself as an investor. We've seen the strategy, we've looked at the risks, and we've seen the sky-high valuation. With so much optimism already priced in, can their big AI pivot truly deliver the kind of explosive growth needed to justify that price tag? And that, my friends, is the billion-dollar question.